Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 17th, 2023 podcast. This week's episode is another installment in our ongoing So You Want to Be a LIHTC Developer series. We launched this series to help real estate developers get a better understanding as to how the local housing tax credit is used to finance the acquisition, development, and renovation of affordable rental housing. Today's topic is an important one for all local housing tax credit developers, both new and experienced. We're talking about today IRS Form 8609. What is IRS Form 8609, you may be asking? Form 8609 is the IRS document that credit allocating agencies give to property owners, evidence that the owner is eligible to claim low-income housing tax credits. Credit allocating agencies accomplish this by completing and signing Part 1 of the Form 8609. Developers, in turn, must complete Part 2 of the form and then submit the completed form to the IRS. And there's a form for each building that is part of the low-income housing tax credit finance development. They might be thinking to yourself, I'm a developer. I build housing. Why in the world do I need to listen to this podcast about a tax form? Can't my tax accountant prepare the form for me? Well, the answer is yes, you definitely should have an experienced accountant reviewing your Forms 8609. But for you as the developer, it is very important that you understand that you are responsible for completion of the form. It's important that you understand the implications of the form. Now, you might also be thinking, if you're an experienced developer, I've built and placed and serviced many low-income housing tax credit developments already. I know how Form 8609 works. What could I possibly learn from this podcast? Well, I would just say, if you are an experienced developer, I do urge you to keep listening, because I'm sure there'll be one or two tips that you learn today that could save you thousands or even millions of dollars. I would say thousands or maybe millions of dollars, because if the Form 8609 is not completed properly, then you as the property owner may need to apply to the IRS via private letter ruling to correct the errors in the form or forms. This process alone could cost over $10,000 in IRS user fees, as well as an additional $10,000 to $20,000 or more in professional fees for assisting in preparing their private letter ruling request. Hence thousands of dollars of additional costs. Now, I say maybe even millions of dollars, because an improperly completed form can result in the loss of credits on a building by building basis. Now, let me also note, if you're not in a local tax credit developers, but if you work with an investor or a syndicator, then this podcast will also be useful. As part of your investment due diligence, you want to be sure to be reviewing the Forms 8609 to ensure they're completed correctly and that they're consistent with your tax credit delivery expectations. Now, in today's podcast, we're going to start by providing an overview of Form 8609, the information requested on the form, and who's responsible for providing that information. More importantly, we'll talk about specific questions that are on the form that you'll want to pay particular attention to avoid potentially costly errors. We are very fortunate to have joining us today for today's discussion my partner, Craig Staswick, from Novogradac's Long Beach, California office. Craig has worked with many developer clients on preparing and reviewing their Forms 8609. He also led a deep dive webinar on Form 8609 back in 2021. And that training was so popular that he came back for a repeat performance and hosted another webinar on the topic last month. If you didn't get a chance to attend last month's webinar, I highly encourage you to watch the webinar recording. You can purchase the recording on our website at www.novoco.com/training. Navigate to the on-demand training courses page. I'll also link to the webinar in today's show notes. Without further ado, I'm excited to have Craig share his insights with us today. So if you're ready, let's get started. Craig, welcome back to Tax Credit Tuesday. You were on the podcast a couple of years ago when we talked about cost segregations. I can't believe it's been that long ago. We're happy to be back on the show.
It's great to be back.
So let's start off with the basics of Form 8609. I described it pretty broadly in my introduction, but please, I'd like for you to tell our listeners a little more about the purpose of Form 8609 and how it's used in the loan building tax credit transaction.
Sure. Right. So the purpose of the 8609 is really twofold. The first purpose being it's the state housing agencies document that they populate to allow the building owner to start taking low-income housing tax credits. So that's the first purpose. It communicates that the state housing agencies review the project and allocates them the credits. The second purpose is really developer driven, and that is to allow the developer the mechanism to make certain certifications and elections that they were required to make under Section 42 in the regs.
So thank you for that overview. And now maybe you could discuss the timing Form 8609. When would a developer receive the form? I mean, a developer, obviously at the very beginning part of the process, if they're going for 9% credits, will apply for the credits. If they're going the tax and bond finance tax credit route, then they'll be seeking tax and bond finance. Either way, before they started the development or the renovation, they're in the process of lining up the credits. Then they apply, then they get award letters, but they don't actually get the 8609 then. When do they get the 8609?
Right. So they actually get the 8609, no earlier than place in service, but to provide even more detail about kind of to fine tune that date, if you will. What the typical fact pattern is the project is placed in service and has X amount of months to turn in a place in service package to the state housing agency. The state housing agency then reviews that place in service package. And if all things goes well, it will then issue the 8609. Timing by state is a little different. Some states require the place in service package to be submitted within 1 year of place in service. And then you can generally assume they're going to take 6 months or so once they receive the place in service package. So the developers need to think about, keep that timeline in mind. And they're really motivated to, after place in service, hustle, if you will, turn in the place in service package to speed that process up.
So one of the reasons why the 8609 comes after the place in service date is all the costs have to be pulled together on a per building basis. So you can allocate out the eligible basis and all the rest. And also the states have to do a financial feasibility determination. And they generally will want the permanent loan to be in place at the time of that determination. And since once you place the building in service, you got to lease it up, you got to get the stabilized occupancy, then you have to have the permanent loan fund. That can all take sort of a number of months. But you do get to start, you're eligible for claiming credits once you place the building in service, but you are leasing it up. However, you may not get the form for 12 to 18 months later, which means the tax return's already been filed. So what are our clients doing in order to claim credits before they receive the 8609?
Right. So that does create a conundrum. You want to take the credits, but you don't have the 8609 in hand. What do you do? Well, the good news is there is IRS guidance out there that allows for a developer to take credits without the 8609 in hand. It's commonly referred to as the reasonable cause approach. That approach it's facts and circumstance driven. So that plays a large role in a developer's ability to take that position and take credits without 8609s. But it's very common because of the reasons you just mentioned of this timing challenge that these projects have.
So thank you for that. And I would just expand on that a bit by saying there is a process that the broader long-term tax credit community has gotten comfortable with in terms of how to document reasonable cause and the various steps you have to do. And you want to make sure that you're traveling within the herd and from that respect and not from the herd, so that you have a greater likelihood of maintaining your credits. Now, another thing before we talk a little more details about the form itself, way back in the day, you used to file the form with your tax return, but you don't do that now. Where do you file the form?
You file the form. It's a one-time submission now to the IRS LIHTC unit, to the specific unit, and you need to send the original wet signature, the developer's wet signature, and the housing agency's wet signature to the IRS LIHTC unit.
Thank you for that. It definitely makes the tax returns themselves that you file a little bit thinner now, because as I mentioned earlier, you have a separate 8609 for every building in a development. And if you do an AC rehab, you have a separate 8609 for the acquisition costs and a separate one for the development costs, for the renovation costs. So you have two forms for building. So you get into a 40, 50 building project and you can have 80, 100 forms or more, depending upon, like I said, how many buildings you have. So it could be a bit voluminous, but
That's
it's now nice that you submit it once to the Irish unit. So now let's talk about the timing and significance of the form itself. In the introduction, I talked about part one is filled out by the credit allocating agency and part two is filled out by the property owner. Maybe you could describe for our listeners in a little bit more detail what the two parts entail.
Right. So it's a one-page form and it's kind of split in half horizontally. So on the first top half is what is referred to as part one. And that part one is filled out by the allocating agency. And it has key data points of the project. It's very useful. It's a good snapshot of the building, how many credits are on the building, what the eligible maximum qualified basis is, and some other key data points. And the key being that is filled out by the allocating agency. The bottom half is the part two, and that is the area of the form that the developer would fill out. It's going to be making various certifications and elections that are required under the code and the regulations.
So I think I want to ask you that and get some more detail there. But before I ask you that question, let me back up a second and say, in the intro, I talked about the developers being responsible for the forms and they should work with an experienced tax accountant to review the form. What are some of the services that you provide to clients in assisting them in preparing part two? Obviously, you're not assisting in part one because that's what the state allocating agency prepares, but some of the services you provide in assisting with the preparation of part two of Form 8609.
Right. So it's very common for myself and our partners, Mike, to get engaged to prepare part two. I mean, the form is a tax form, so it aligns perfectly with what we do on a day-to-day basis, which is prepare tax forms. So we get engaged in part two. It's very common. As part of that process, as a value add service, we review part one because we have seen errors, human errors made in part one. And this is the time and opportunity to get those things fixed now, as opposed to before they're sent off to the IRS.
And that part one, they prepare part one, you review part one to see if the state maybe made an error, the allocating agency made an error preparing part one and they try to get it corrected. And then you assist in the preparation of part two, which is the part that the taxpayer is responsible for.
Correct.
So you gave an overview of part one and part two in general. Maybe you could be a little bit more specific and talk about some of the areas in part one and part two that a developer or property owner should be paying particularly close attention to, and go at a really high level here, because then we can dig back down in subsequent questions on the details of each one.
Right. So where I focus on and where I think developers should focus on, I'll separate it by the parts. So for part one, it would be line 1A, the date of allocation, line 1B, the amount of credits. Some would say that's probably the most important line. Line 3B, the 130% boost under the DDA QCT provisions, and line 5, the place and service date. For part two, there's the areas I mainly focus on, although all of them are important, is line 7, eligible basis, line 8A, the original qualified basis building at the close of the first year. Line 8B is the multiple building election. That is an area where we spend a lot of time on. 10A, which is the election to begin the credit period or to defer to the next year. And line 10C, the minimum set aside election.
So great. Thank you for that overview. So let's start with the 4 lines of part one that you mentioned, the part that the credit allocating agency completes. First up there with those 4 lines you mentioned was line 1A, which identifies the date of the allocation. What are the keys to getting that date right? So if it was off, what concerns might a developer have?
Right. And so the reason why I look at that and we look at that is for 9% deals, there's a timely place and service requirement. And as part of that math, if you will, it really is comparing the date of allocation to the place and service date. Both of those data points are on the form in part one. And so I want to make sure the data allocation compared to the place and service date it is not only accurate, but it's meeting the test. And I have seen situations where the date of allocation through human error is noted as a year earlier. So same day and month, but a year earlier. And the story that tells is that the project was not timely placed in service. So I look at that to make sure that is accurate.
And are there any particular aspects of that date with respect to a bond finance transaction versus a 9% transaction?
No, there is not.
Okay. So the second line you mentioned was line 1B, which is the maximum housing credit dollar. Aside from the obvious, making sure that the credit you were expecting to get is on that line, is there anything else to pay attention to?
Surprisingly, no, but because I'm doing a podcast on the form, I struggled with, well, how do I not talk about the amount of credits, that line? So no, I've never seen an error. I've never seen something wrong or a pitfall. I think that developers would catch that on their own, and just you're making sure it's the amount that you were expecting.
So the third line you mentioned was line 3B, which relates to the high cost area provisions of Section 42. What do you want to highlight about that?
Right. So what I wanted to highlight about that is if the project does qualify for the 130% boost, high cost provision, DDA, QCT boost, make sure that the box is checked and it shows 130% there. I have seen situations where on a 9% deal that has excess eligible basis and mathematically doesn't need the 130% boost to generate their reservation amount of credits. I've seen in that situation, not common, but I've seen it where the box wasn't checked and it just showed 100% instead of 130%. And I look at that and I go, well, first off, it's not accurate. And second off, the developer would be motivated to show the boost because it almost provides some level of audit assurance, if you will, but future years, because you have more excess basis in years where if you have a down unit or an over income unit, that can help mitigate potential recapture. So that's why I look at that and to make sure if you have it, make sure it's presented correctly.
No, that's an important factor. I've seen that as well, where it's not needed. So they think, well, why bother? And you want to bother because it can help avoid losing some credits in the situations that you mentioned, as well as others. So last, but certainly not least, of the part one lines that you mentioned was line 5, which identifies the date the building was placed in service. What did you want to highlight about that line?
So yeah, a couple things. So I've seen situations where that date is using the certificate of occupancy date rather than the temporary certificate of occupancy date. And so generally speaking, probably in all cases, really, the developer would be motivated to use the TCO. Not only is it accurate, that's what you're supposed to use if the building is ready for its intended use, but there's other reasons for that. It's such as having a TCO dated December 1st and a C of O dated December 5th means you can take credits for December because you have that TCO dated December 1st, which is required. You have to have one full month before you can start credits. And so you don't want to turn in, you want to be able to take advantage of that so you can make sure you can start the credits where they should be started. And that's the main thing I wanted to emphasize there is where I see some developers will turn in their place in service package, the C of O, instead of the TCO if they received a TCO. And the state doesn't know that there was a TCO. And so that's how that number or line 5 can get populated incorrectly.
That's a good point about the TCO date versus the final certificates of occupancy. And because obviously you want to start claiming the credits, generally speaking, as soon as you can. So the TCO would be the earlier date. And the TCO is commonly used, a temporary certificate of occupancy is commonly used as demonstrating the date where the property is ready for its intended purpose. That's when depreciation starts. And as a consequence, that becomes the place in service date for LIHTC purposes. I would note, though, that you have to be careful. This really isn't about the 8609, but just for the benefit of our listeners, I have seen temporary certificates of occupancy that were limiting occupancy such that it didn't meet the test for tax purposes of being the place in service date. So it's something that you want to make sure it's not, you don't just look at it. This is for the developer. I know you know this, Craig.
Right.
But for our developers listening and others, you want to make sure you read if there's any conditions to the certificate of occupancy, the temporary CO, such that you do meet the requirements of tax law for it to be the bright line, if you will, the evidence date placed in service.
Right.
So now let's move on to part 2 of the form. And that's the area where the developer has to populate various entries, numerical entries, as well as check boxes to determine what elections they do or don't want to make. And then first up in your list was line 7, which asks for the eligible basis of a building. Basis is, generally speaking, depreciable basis of a building. How complicated can that be?
It can be very complicated what eligible basis is. The good news is the eligible basis, by the time the developer receives 8609 to populate the part 2, you've already had audited final cost certification, which will have your eligible basis. Where I see errors in populating line 7 eligible basis of part 2 is not showing the excess eligible basis. I've seen that happen, and it follows along the thought I was mentioning earlier with the EA. If you got it, show it. And so show the excess. And when the definition of eligible basis is, it also includes the DDA QCT. So that is baked into the definition. So it's accurate to include that in addition to any excess eligible basis you have. So I just wanted to make that point there. That's what I see. Sometimes it's shorting it because for the similar reasons, but you shouldn't do that.
And one of the things that we won't get into in the podcast here, but it kind of ties in also to reviewing part 1. The part 1, as you noted, has the tax credits per building. And then part 2, you're reporting your eligible basis per building. And all that's not done just based upon the number of buildings. If you had $1 million of allocation and 10 buildings, you wouldn't just necessarily have 100,000 across all the buildings, because some buildings have more units than others. So you do have to end up looking at the allocation of the credits among the buildings and then the eligible basis among the buildings. Like I said, that's probably closer to the cost segregation podcast that you were before.
That's a fair point. All of the cost certs that I've audited really just audits it as a whole. And so it doesn't show it if it's a multiple building project, how to slice up the eligible basis between the projects. So that is another exercise, you're right, during the part 2 preparing that needs to be completed, as well as how to allocate the eligible basis between the various 8609s.
So the second line that you listed was 8A, which asks for the original qualified basis of the building at the close of the first year of the credit period. So maybe here you can talk about how qualified basis is different than eligible basis and why it's focused on qualified basis to close the first year of the credit period.
Right. So the qualified basis, although similar, it uses eligible basis as part of its computation. And it'll multiply, it'll include whether or not the project is 100% affordable. If it's something less, it'll use that percentage that's not affordable as well into that computation. So your qualified basis in theory could be less than your eligible basis if you're not 100% affordable. But I don't see any errors there. The point I wanted to highlight for the new developers in the industry is that it's measured at the end of the first year of the credit period. So there's just that little nuance there, that it's measured December 31st if you're a calendar year taxpayer. And so that's the only kind of nuance there. I'll also point out there is some COVID relief relating to units leased up in the second year and its role in whether or not there's recapture or not, which we have in other webinars.
Yeah, the COVID relief dealing with the measuring your qualified basis at the end of the first year of the credit period definitely is a bit involved. I would just note to our developers that if you're 100% low income development, you're not 100% leased by the end of the first year that you place the building in service, or by the end of the year after you place the building in service, you should be looking into this COVID relief to see if, for purposes of making this calculation, you get to count units that were leased after the end of the first year of your credit period. And even what I just said there has a lot of complexities to it. But I think it was accurate. It's just the key there being that if you're not 100%, if you're intending to be 100% affordable and you don't reach that 100% affordability occupancy by the end of the first year of your credit period, then you run the risk of not getting all your credits over 10 years. They'll really spill over to 11. You run the risk of claiming credits over a longer period of time, 15 years, which you're not expecting. It's going to lead to tax rate adjusters. A whole host of bad things can happen, but that's a lot of the planning you'll be doing with a tax accountant as you're approaching the end of the first year of the credit period. And also when I think of qualified basis, eligible basis, I think of eligible basis as being in short, the depreciable basis of each building. And the qualified basis of the building is that portion of the building, the basis, the depreciable basis, if you will, that's associated with low income units. And obviously if you're 100% low income, then they're the same. But if you're not 100% low income, if you're a mixed income development, then it's going to be some percentage, your local occupancy percentage of your eligible basis. And then of course you have to layer in the 30% boost if you're eligible for that. But let's move on to the third line that you wanted to highlight, which was 8B, and that's the election. And it's something that we get lots of questions from clients about, and you have to decide if you're treating the building as part of a multiple building project or not for purposes of Section 42, which kind of ties into, one of the challenges, if you actually read Section 42, the code itself, the times where it talks about building, times when it talks about project, and there could be complexities and differing interpretations there depending upon if you're applying something at the building by building level or a project level. But this is a more tailored focus question where they're asking, are you treating the building as part of a multi-building project? So it can be a potential pitfall how you answer it. So I was thinking, Craig, you could share the significance of that question and maybe any common errors you see.
Right. So the significance is it plays a large part in how property is operated, because you can group buildings into quote unquote projects, and those projects have to be operated together as an aggregate in certain ways. Or you can choose not to group them, various buildings, into a project, and they can be kind of looked at separately. And there's pros and cons. We have various webinars and handbooks about making that decision. Generally speaking, the kind of rule of thumb is if there's multiple buildings and it's 100% affordable project, you're more than likely going to be making the multiple building election. If you're mixed income, you may not be. For instance, one scenario would be in multiple building project, mixed use, but maybe some of the buildings are 100% affordable. The developer might be inclined to group the 100% affordable buildings together in one group to take advantage of some of the pros of making the decision. And that way you can take advantage of some of the pros, whereas you maybe won't be able to if you do that.
Have you checked yes to the question? Are there any attachments that you have to provide?
Yes. And I'm glad you asked that, because of all of the Part 2 certifications and elections, this line 8B, the multiple building election, is the area where we see the most errors and the most grief, if you will. And one of the errors is when you read the instructions, it clearly says, if you want to make this election, you have to attach a statement. If you don't attach the statement, it's as if, even if you checked yes on the form, but didn't attach the statement, it's as if you checked no. And that can be really detrimental if you continue to operate as if you checked yes, and you're making all these kind of tenant transfers they're not swaps, they're now treated as new move-ins, and a whole host of other issues. And so the point I really want to make here with this line is make sure the election is done correctly, which is to include the statement. We've seen that many times.
So maybe just to summarize, generally speaking, clients will treat the developments as one overall project, all the buildings in a single project. They'll answer yes, and then attach a statement listing all the buildings as part of a single project. But there can be more nuances, but you want to make sure that you understand the implications of doing something different.
Right.
Lots of resources to help evaluate that.
Right. The other thing I'll just add to is whatever you end up filing to the IRS, make sure the property management company, because sometimes those are third parties, are aware of what was elected so that they can make sure they are operating the project in the way that makes sense with the elections.
I'm glad that you mentioned that because it's one of the challenges as we keep talking about filling out the form, which is going these little tangents is you can't emphasize enough that whatever is being done with respect to filling out the form 8609, making the various elections and all the rest, there are implications as to how the property is managed. And you've got to make sure that everyone within the organization that needs to know how to manage the property knows how to manage the property and they know what elections have been made. So obviously a property management company should be reaching out and saying, I need this information. They should know enough to know they need it. But similarly, rather than relying on that, you need to make sure that you're giving it to them and confirming with them that they're operating the property in a fashion that's consistent with the elections made on the Form 8609. So I think there are two others, if I remember here correctly, that you wanted to make sure that we talked about. And they're both parts of line 10. They're both irrevocable elections. So let's look first at there's 10A and 10C. Let's talk about 10A, which asks the developer wants to elect to begin the credit period the first year after the building is placed in service. Let me say that again, because it's not worded so great on the form. It asks whether the developer wants to elect to begin the credit period the first year after the building is placed in service. And it's a yes or no question. And what should developers be thinking about in how to evaluate answering that yes or no?
Right. So the developer is in almost all cases very motivated to start the credits as soon as possible. And so by default, they're almost always going to want to check, no, I don't want to defer the credits. I want to start it now. But what you need to think about is there is a cliff test. As we all know, there's various cliff tests, Section 42 projects. One of the cliff tests is the minimum set aside test. And that needs to be met annually, but especially at the end of the first year of the credit period. If you're checking no to not defer, you're starting the credits in the current year that it was placed in service. You need to make sure that the project is meeting the minimum set aside test. The other thing to consider is, if not fully leased up by December 31st, if you're a calendar year taxpayer, to be debating, ignoring COVID relief, you're going to be debating whether or not to start the credits or defer them. And I think that is a mathematical size where, what's the impact in equity both ways, right? So if you start the credits, but not fully leased up, what does that mean for equity and credit delivery stream? Because remember, ignoring COVID relief, any units that become qualified units after year one are subject to the 2/3 credits, what's commonly referred to as the 15-year credit stream. So that's going to have, generally speaking, a negative impact on your equity. And you have to weigh that versus delaying the whole to checking yes to defer. So to me, it seems like it's more of a mathematical calculation of where am I better off as a developer,
right,
relating to tax credit equity.
Now that makes perfect sense. And when I see it, it tends not to be so much the minimum set aside issue because properties generate 100% or 80%. If you're 20% or 40%, then that's going to be affordable. Then it can become more of a cliff effect type of issue. It's generally more they'll have a basis to claim credits over 10 years. And I say 10 years, but it's really 10 years and spill over 11. Or am I going to claim credits over 15 years? Which could have a dramatically adverse effect on your net equity and could lead to a big adjuster calculation. Right. So the other irrevocable election that you mentioned was 10C, but we talked about 10A and 10B and 10C. So it makes me wonder, maybe we should tell the listeners what 10B is. If you wanted to mention what 10B is, then we can jump to 10C.
Yeah, sure. 10B is elect not to treat large partnership as taxpayer. And it's worded almost as fun as the defer the credit period question. And it's not a yes or no, it's just a yes option. It's very uncommon.
Well, first of all, you don't have large partnerships, but that's a big one where if you ended up with a large partnership, which I remember correctly is 100 partners, right, then you can actually, your recapture rules change. There's a whole host of implications to who has recapture risks and the rest. But everything that we're dealing with are small partnerships. So it's a somewhat irrelevant question. And I must say, I don't know that I've ever worked on a partnership where we were making that election, but I may not be quite right. So the other irrevocable election that we mentioned was 10C. which ask what minimum set aside is being elected. And this is probably, when I think about getting private letter rolling requests to correct elections, this is probably the one that I see the most often. And it's something where we get brought in a few years later where the developer was a local developer using a local accountant or something, and they weren't fully aware as to what this meant. And it made an election that was the improper election. So maybe you can unpack the significance of this minimum set aside election, because there's 4 choices. Maybe you can talk about the 4 choices and which ones you generally see.
Right. Yeah. So there are 4 choices. It's the 20 at 50 minimum set aside, the 40 at 60. The third one is a new one. It's the new average income election. And the fourth one is the 25 at 60, which is for New York City only projects. Generally speaking, for 100% affordable projects, it's been at 40 at 60 has kind of been the default for decades. What I wanted to talk about with this line is...
Just interrupt you there, just unpack the 2050, 40, 60. The 2050, for the listeners that aren't as experienced, means the minimum set aside test is all about setting aside a minimum number of units for low income occupancy and to be rent restricted and the rest. And it's a vestige, or they took it from the productivity bond finance rules, where it'd be for your bonds to be tax exempt, and when they're used to finance residential rental housing, you have this minimum set aside test. And remember, there'll be units that set aside for low income occupancy. And it's either 20% of the units at 50% or 40% of the units on a minimum basis being set aside to rent to tenants with income levels at 60% or low. So 20% of the units at income levels 50% or below, 40% of the units at income levels of 60% or below. And when I've seen an error, it's been the prior accountant checks the 2050 thinking it's units, even though the income level is a little bit lower. Whereas the problem with that, of course, is your rents for the entire project are based upon that minimum set aside election. It's subject to other limitations that could be on the property at the state level or the federal level. But, the consequence being that you're agreeing at the 2050 election that all your tenants will be income levels at 50% or below, and your rents will be based upon that 50% level versus your rents being based on the 60% level. And if you're going to be 100% affordable, then you're easily going to pass the 40% test. So you want to have the higher rent floor and the higher level qualifying tenants for income at that 6% level. And once again, subject to other requirements the other commitments you made to the state when applied and received your credit allocation. So sorry for that transgression, but, or that that wasn't really a transgression for that further explain.
No, it's good. That was good, especially for developers. They definitely need that context. And the other thing too, Mike, that I was going to discuss or just bring awareness really, is it used to be 3 options on this line 10C. A few years ago, it added a fourth, the fourth being the average income election. Industry received final regulations late last year. There's still some emerging kind of issues that need to be kind of worked through in the industry. But some of the chatter within the industry is maybe one day when some of those issues are resolved, the average income election is going to be kind of the default and replace what is now the default being the 40 at 60. So that's pretty interesting. I just wanted to bring awareness to the developers. There's that issue out there that,
I definitely think that's a good point, because as you noted in the past, there's the 25% and 60 for New York City. But if you're not in New York City, you really had the 40/60 or the 20/50, and clients pretty universally elected the 40/60, even if all their units were going to be rented to tenants at 50% or less. And we don't need to go into all the reasons why, but 40/60 was pretty universally elected. And I do believe that going forward, once we get guidance from individual credit agencies, guidance that I think is needed just to close any particular risks, that, most developers will be electing the average income. And I say that from a federal statutory construction perspective, that most developers will be electing average income at that point. And it could happen within 12 months. But I say from the federal perspective, because I have spoken in front of groups before, I'm sure you have as well, where I've made similar observations, and then developers will say, but they'll say, I don't agree. and I'll kind of go through all the reason why at the federal level, that's the overlay. And they'll point out that some states might say, in order to elect this, you have to agree to certain other things. And that's kind of the assumption when I make that general default comment is some states might say you can only elect average income if you agree to do certain other things. And some developers may not be in a position to do those other things. So they won't elect average income. So, but for the state restricting your ability to elect it, I think there's a lot of compelling reasons why average income provides more insurance against future loss of credits than the 40/60 does. Let's move on from that. I appreciate you going through and highlighting the key parts of part 1 and part 2 that developers should pay particularly close attention to. But obviously there's other parts of the form that need to be attended to as well. But I hope this isn't the case. But I wouldn't be surprised if someone listening to this podcast says to themselves, that's an interesting point. And they go back and look at their 8609s and they discover that they actually made an error on their Form 8609. And I mentioned in the intro about the importance of if you find an error, you need to go and approach the IRS and get a private letter request before you're under audit to see if you can correct the error in the election. So if you could describe why you have to do it before you go under audit for a partnership, and maybe describe the process of getting a private letter ruling request, or getting a private letter ruling as well.
Right. No, I'm glad we're discussing this because what I don't want is I don't want developers to find error and then they look at the amount it costs to do a private letter ruling and walk away with, well, I'll just do the private letter ruling, when the IRS audits me. And when you read the private letter rules, you generally cannot do a private letter ruling once you're audited. So I don't want people to think you can just do it when the IRS is auditing you. So if you have
to say that, and it makes sense because the IRS doesn't want that either. The IRS is saying if you made it a wrong election and you identified it before we started auditing you and you want to correct it, we've got a process to go through. And if you meet the various requirements, you can change your otherwise irrevocable election. But once we start the audit, game over on that front.
Right. So I wanted to emphasize that. And I agree. It does make sense regarding the process. As you mentioned, the amount of professional fees associated with this, it's a very formal process. It's quite lengthy. So I didn't want to get into the nuances of the process. It's very formal.
Okay.
The other point I'd like to make is I also wouldn't think of it's a given that you'll get the ruling that you want. So facts and circumstances clearly play a large role in the private letter ruling request and how the IRS will respond to that.
No, I agree with that. And a lot of times the private letter ruling is all about a transaction or something you want to do. And you want to get clearance from the IRS as to what the treatment will be when there's an area that you have a particular concern about. But the private letter rulings where we're dealing with correcting an error of an election, there's a pretty high success rate.
Yeah.
Clear that it was an error because you have so many other documents that document what you intended there's a very high success rate. And we see all the time different private letter ruling requests. If you go to our website, you'll see lots of PLRs correcting elections that were made in error. So you can, and there's also a pre-conference process with a private letter ruling request where you get a good sense as to which direction the IRS is headed. So I think that in the issues that we're talking about here, there'd be a high success rate, but you point out not a universal success rate.
Correct.
And it's all about preparing it and using experienced professionals so they know the right questions. They understand what the IRS is looking for, so you can make it as easy on the IRS as possible. So before we close, I can't help but ask just a more general question. What other advice would you share with developers about Form 8609? And this is if you plug the webinar, because that's obviously a must listen.
So definitely the deeper dive webinar Wayne and I did last month to get just kind of into the weeds and trenches, if you will, of some of these issues. And then just to recap, mistakes can be very costly. Take your time when you review the form and have multiple parties review the form as well, including your CPA.
A great point about multiple parties within the client. Definitely
It's hard to
one
catch
where,
your own ear.
yes. And it's also one where we talked earlier about making sure the property management team gets the 8609 after you made the elections, but really they should be involved in making the elections.
Yes.
They should be aware of what you're completing on the form, and they should be a group that reviews it before filing them. So thank you, Craig. As I mentioned, I'll include a link to the webinar recording in today's show notes. And please do stick around, Craig, for our off-mic section of the podcast, where I'm going to ask you some fun off-topic questions so you can share some of your words of wisdom or advice. To our listeners, please be sure to tune into next week's podcast. It's another great topic for affordable housing developers. On the podcast, my partner, Rich Larson, will be my guest, and we're going to talk about the Rental Assistance Demonstration, or RAD program. And more specifically, we're going to cover some hot topics. RAD, as you may know, is a HUD program that helps finance the construction, rehabilitation, and preservation of affordable rental housing through the conversion of public housing. RAD's a particularly timely topic and opportunity for developers. And I say that because with higher interest rates, I think that there'll be somewhat less new construction being financed through productivity bonds, which creates a great opportunity for the RAD program to access productivity bonds to finance the acquisition and rehabilitation of public housing. You want to make sure that you don't miss that episode. And now I'm pleased to reach our off-mic section. It's a fun way for listeners to get some tips and recommendations from our guests. I have a couple of questions for you, Craig. The first one is, and it's one that I love asking, and it's timely for the new year, not just for tax accountants heading into a busy season, but also for everyone who has New Year's resolutions. What's your favorite productivity hack?
Oh, it's a good one. So my favorite productivity hack is by far, and it's kind of new for me somewhat, I've really just kind of taken it to another level, is there's so much software out there for automating various redundant tasks. And so I won't give the software I use some free publicity, but the one I currently use, I send out certain emails to clients or even internally when certain things happen, like a box is checked or this is checked, and it's all automated so that, there's some logic built into that software where if this is checked, send this email and blah, blah, blah. So taking advantage of the software out there today has been a huge productivity hack.
Now, I appreciate that. As many listeners know, I do that through Outlook in terms of, various incoming emails automatically going different places and the rest. And I'm constantly in search of things like that.
Yep.
Automate. So that's a good tip. So my other question is what book you would recommend that listeners add to their reading list. I think I've mentioned in prior podcasts that the one thing COVID did for me is got me back on the reading train, and I really kind of enjoyed that. So I always like asking guests this question so I know what book they are adding to my reading list. I read it already.
Well, I don't know if you'll be adding the books I recommend, Mike. So the books that I recommend is geared towards parents of toddlers.
Okay,
those are the
right. Those
are the books I've been reading as of late. We've been reading the Berenstein Bear books. Those have held up quite well. So we're reading those at story time every night.
Okay, Berenstein Bear, you are correct. I will be reading those, but it's not because I haven't read them.
Right.
It's because I probably haven't read all of them, but I read a large number of the books. So that's a good recommendation.
Yep.
I will also say there's another children's book that it has become something that is like a lesson for me. And it's a book called Give a Pig a Pancake. And it's all about, they give a pig a pancake and then they want syrup and you give them syrup and then they need a plate. And then it just kind of goes through all the things that happen where you just start by giving a pig a pancake. And there's large things in life where you think about it, and you're like, well, I do this one little thing. Think of all these derivative things that are going to happen. So I'll give you that to add to your reading list.
Thank you. We will put that in the rotation. I haven't heard
Put
that.
it in the rotation.
Yeah.
So thank you again, Craig. And to our listeners, Mike Novogradac, thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday